Hi, ladies and gentlemen. I'm Shelly Kraft, and I'll be moderating today's panel on MicroCap Alternatives for reducing costs, raising capital, and managing liquidity in 2024. Now, from my perspective, when I look at this panel of my colleagues, I see a mini ecosystem. So for companies that are joining us, any issuer, pre-IPO company, private company, a lot of the questions that are going to be asked by me of this panel and their answers are really going to pertain to what's going on in the market and how you can benefit and get some questions answered from this right here, this panel. So I'm going to start with Joe Alagna. Please give us a brief description of what you do, your name, et cetera, and then we'll go down the line, and then I'll ask a question right after that.
Hi, everyone. I'm Joe Alagna. I'm the chairman and CEO of Joseph Gunnar and Company. The company was founded in 1997. We're an investment bank. We do underwritings, all different types of transactions, public and private transactions in the market, predominantly microcap transactions.
Hi, my name's Anna Serin. I'm Director of Listings Development with the Canadian Securities Exchange. We're a stock exchange in Canada, and we host over 800 companies. Many of them are domiciled in the US, and so we have quite a good relationship with capital markets down here in the US. That's it.
Thank you, Shelly, and thank you for joining me today. My name is Joe Oltmanns. I'm with OTC Markets Group. I've been in OTC Markets now for 14 years. My role really at OTC is to help companies make good decisions around their listing, whether it's an uplist from our pink market upwards to QB or QX, or it's a cross-listing from the CAC, for example, or it's a direct listing, or more common these days are switches from the exchanges to our market. But about OTC, we're not, as many people would think or say sometimes, an international exchange. We just, don't trade just ADRs on our platform. We're also not just a micro-cap, market at the same time. We're a diverse market of 12,000 securities. It is very large. If you do compare us to the exchanges, NASDAQ trades roughly 3,500 companies. So looking at us as a market, we're very diverse and we're spread across the globe. Thanks again, Shelly.
I'm Jason Bishara, Financial Lines Practice Leader at NSI Insurance Group. We specialize in outsourced risk management solutions for microcap companies, sub $300 million market cap companies. My individual practice does. So all of the executive risk, predominantly the D&O insurance, operational risk, and employee benefits, we provide complete comprehensive solutions.
My name is Shawn Severson, co-founder and president of, CEO of Water Tower Research. We provide an open access research platform that enables investors to access company research. We create an ecosystem that really works with the company, designed to create transparency in the information flow. As you know, most of you, it's really become difficult to get information flow between regular broker-dealers and the broad, diverse base of investors. So our job is to work with companies, create research product in an open access forum and an ecosystem for communication that really opens up the information flow and enables companies to communicate with investors and investors to find companies.
Let's start with Joe Alagna from Joseph Gunnar and Company. Joe, how would you best describe the state of the microcap market from a capital raise perspective? And as an underwriter, let's hear your take on that.
Well, I'm very encouraged recently about the market has been improving a bit, but it's still quite volatile. We went through quite a bear market in the microcap raising market over the last since 2021. If you look at early 2021, there was about a dozen stocks trading under $1. By the end of 2023, there was 557 publicly traded NASDAQ stocks trading below $1. That's a mind-blowing number. And if you think about many of those companies that are were trading below $1 then are not financeable anymore, and many of them are getting delisted now. But the good news is the risk appetite has started to increase recently. If you look at some of the large cap IPOs, you're starting to see. I also manage a pre-IPO fund with large cap private companies. I'd like to look at some of those companies as kind of the predecessor of what's going to happen with our market, because our market tends to lag. Recent companies like Instacart and Reddit and Rubrix recently trading very well after going public, I think are positive signs of where the market's going to lead into the end of this year into 25. So I'm optimistic. I think that I've been doing this for 35 years, seeing this cycle before, these things happen. They're cyclical. They happen, sometimes the cycle lasts longer than others, but I do start to see the signs, the green shoots that are out there, that I think that the market is starting to improve, and especially in microcap, I think 2025 we will be, I don't know if we're going to be off to the races, but I think we're going to be in a lot better shape than we were a year ago.
Thank you. Anna, how do you utilize, how would an issuer utilize the CSE as a cost-effective platform to raise capital and develop growth and build shareholder equity until they're ready for uplisting to a senior exchange?
Well, for those that maybe don't know much about us, we've been around for about 20 years in Canada, which makes us babies in the land of exchanges. And we came to the market recognizing that we needed to have more cost-efficient and efficient marketplaces for startup and growth companies to access capital, which is the reason that we came to be. We've been one of the fastest growing exchanges in the world several years over now, and it's obviously proven that this is what is a requirement in the capital markets. One thing that the capital markets add to the investability or the ability to invest is cost and a lot of resources and a lot of extra time. And so the ability to reduce these costs, which is what the CSC came to market for, becomes ever increasingly important as we have the markets that we've had in the microcap space. I think that one thing that both shareholders and companies are seeking is liquidity and good share price, and those are created with companies doing everything that they can to reduce the costs. The Canadian Securities Exchange, as we started, was more of a disclosure-based exchange that has developed a little bit as we've grown as big as we have. We've also developed a senior tier to our exchange just because some of our companies became so big we couldn't treat them like the little companies anymore. The opportunity that the CSC has for companies that are domiciled anywhere in the world is a cost-efficient marketplace and low cost of capital. We also have a formalized relationship with the OTC markets, which I'm sure we'll talk about a bit further, that if you come and list in Canada, that you can automatically get your OTC ticker and come back down to the States and raise capital cost efficiently as well. This is really important when you're small and growing as a company. When you get to a certain size, the costs and the resources required for the larger exchanges might make more sense. But in these markets and for smaller companies and microcap companies, it's ever important.
Thank you. Joe, let me ask you this question. When you are listening to companies, what are some of their most pressing questions, and why are companies switching to OTC?
So I think Joe touched upon this earlier. 2021, was a banner year for the exchanges and IPOs. There's no doubt. I don't think we'll ever see that year again for a very long time. But I think 2024 will be a banner year for OTC markets and switches from the exchanges. Costs are increasing, right? And looking at being a public company, between the audit costs, legal costs, the exchange costs, it's very expensive. And so with that, to Joe's point earlier, there are roughly 500 companies on the exchanges out of compliance. Many are below either the equity or the BRIC standard. And many are faced with, paying another $80,000 plus to remain on the exchange. And for many of these companies, that number is payroll for a good, maybe 3 months or 6 months. So cost-wise, again, I have nothing against the exchanges, whether in New York, NASDAQ, or even CBOE. I know Andy Hall at the NASDAQ very well. I know Paul Dorfman at New York very well. I don't know Eric at CBOE well at all, but I'm sure he's a nice guy. He's Canadian. Most Canadians are nice people.
Now.
But my point being is, looking at, where we fit into the ecosystem now, with expenses being as high as they are, there isn't really, in my opinion, much value in being NASDAQ listed at, for example, a 10 million market cap. It's just, there isn't the value there behind research coverage or institutional ownership or financing to really drive that decision. But nonetheless, cost, to answer your question, Shelly, cost has been the biggest driver for companies moving off of the exchange onto our market.
Thank you. Okay, let me ask a question to my D&O friend over here. What is the best way to manage the cost of D&O insurance for microcap companies?
So the largest expense outside of payroll for most microcaps is the cost of insurance. The largest piece of that insurance is the D&O coverage. One of the most important pieces of coverage, especially for everybody who's operating those companies and protecting the personal interests of the individuals operating those entities, is the D&O. So it's very near and dear to most executives' hearts. But not all public companies are created equal. Large publicly traded companies should not be underwritten the same way that smaller publicly traded companies are underwritten. So understanding the insuring clauses of a D&O policy, which is very different than standard insurance policies, is important for every executive to be aware of, because there are ways to negotiate through those insuring clauses that are more specific to what the individual needs are of your microcap company. So that could be going lower on the primary ABC coverage and focusing on the excess side A only coverage, because the excess side A only does not share in the limits of the ABC. And we could go into a whole wormhole here of getting deep into the insurance language, which I won't. What I will say is they're not equal. Look at the difference of the insurance policies. You don't have to carry huge limits based on traditional risk management methods to protect yourself and protect your own personal interests. There are ways to understand the policies, look at the structure, and structure the policies specific to your individual needs. That will reduce cost significantly.
Thank you, Jason. Shawn, let me ask you a question. What are the unique challenges smaller companies face in reaching investors, and how does sponsored research overcome that?
That's a great question. I think it's, now you're public, now what, right? So now you're out there and you've gone through this process. And I spent over 25 years as a senior research analyst, and one of the things that changed dramatically during that time is the targeting and the access of information to small cap investors, and what is a small cap microcap investor. And so for companies, it was always conventional research that would provide the support. There were sales forces that were out there, but that's really gone away because it's hard to make money in small cap microcap research. It's better on the banking side. There's certainly a lot of opportunity, but now you're out there, so now what? Investors don't pay research firms like they used to. So there has to be an alternative method that comes in and enables access for all investors to find the research, to learn about the company. I think sometimes companies think there's somebody in a room, going through annual reports that's waiting to discover them, and that just doesn't happen, right? There's, you're looking at 3,000, 4,000 companies out there, and so how do you get noticed with investors? And you have to provide research, you have to provide content, and companies, quite frankly, have to take control of that themselves these days. It's something that they have to take the initiative to do, and using sponsored research, using communication strategies that have valuable and useful information that is accessible to every investor is the starting point, one of the starting points, along with many other things. But, it's that question, you're public now what?
Shawn, I want to come back to you with another question on the topic. My experience in the street has always been that research is only as good as who reads it. Mm-hmm. Please take that question and answer it as you would.
Yeah, it comes down to then getting it to as many people as possible, right? Because you need the readership, you need the sponsorship from the investment community, and I challenge you to easily identify who is the investment community today in a smaller microcap name. It's scattered across tens of thousands of different investors. It's a family office in Salt Lake. It's an RIA in San Francisco. It's an individual investor day trading in their mom's basement. It's all across the board. So, getting to the readership is key. And so it starts with having something that they find useful. and then making sure that you make it easy for them to get to. In our particular strategy, we think frequent and in small bites and free is a great way to get investors' attention. It sort of changes the way research was done with big, 100-page industry pieces that Goldman Sachs would put out, and that just doesn't apply to small cap and micro cap investing in many cases. So getting to the readers, getting them engaged, finding the investor. We happen to use data heavily on that, so we look for engagement with the research to identify those investors. But you're absolutely right, because it starts with awareness. Nobody can buy your stock if they don't know you exist. And then once they know you exist, you have to keep them engaged. And so that readership is critical, and you can't just do it, stop and start. You have to be consistent with it to engage for investors, because otherwise it's always, what have you done for me lately?
Okay, good answer. Let me switch to Jason for a minute. So, when is the best time to buy D&O insurance? I'm talking about, I'm a private company, I'm a pre-IPO company, I'm in registration to go public. Is there a course that you would recommend a company? Let's start with the private and upward.
So I appreciate that. The best time to buy coverage is as early as humanly possible. Understanding, again, the mechanics of a D&O policy or the intricacies of those policies, establishing and setting a retroactive date is the most important piece of establishing your D&O policy, which is the date when coverage is going to extend back to. The most cost-efficient time to purchase these policies is when it's private. The best time to build and establish a relationship with the underwriters and the carriers in the marketplace, because your policies actually have to get sold to those underwriters. They have to be sold on the risk. If the brokers are doing their jobs efficiently, they're literally packaging your company, your risk, and underwriting, and presenting that actually to the carriers. So the more the carriers and the underwriters understand and are familiar with the management, have communicated, maybe you've got 3 years of depth of communicating, and they're familiar with the risk and how the management team actually operates, all reflects in the premium that you pay. So establishing the policy earlier will save you a lot more money later and also provide you with a lot more coverage. So when is it appropriate? Many private companies that are never intending on going public have D&O policies, even though they don't have a cap table or any more shareholders than themselves individually, because you could still have vendor risk and other things. So every company could potentially have one, right? But the reality is, if you start raising capital in any form, you really should get a D&O policy, and that's the time that it should be put in place. It shouldn't wait until the point in time when there's a transaction and the attorney who's structuring the deal, getting you ready to go listing, is telling you that you need the D&O policy. You're going to pay a lot more money at that point in time for the policy, and your coverage is only going to start on the day in which you actually established it. It's not going to cover you for anything that you did before that. So start early.
Thank you. Joe Oltmann. Tell us about the types of companies that are listed on OTC markets.
I mentioned this earlier, but we're a very diverse market. I think many people sometimes pigeonhole us as being a market of nano cap or micro cap, or just ADRs. But again, we're 12,000 companies across the board, spread across 3 different markets: OTCQX, OTCQB, and Pink. On the QX side, it's our best brand. You'll find there are more seasoned revenue-generating domestic companies and our larger ADRs, such as Heineken, Roche, or Adidas. The middle level is OTCQB. That's our venture market. Usually pre-revenue type companies will list on OTCQB. And then we have the Pink market at the bottom. Pink, there is a need for. The Pink market does not have any listing standards like the top 2 markets, but Pink does have a purpose. So for companies like WeWork or Bed Bath Beyond that fell into bankruptcy and came off the exchange, they went to our Pink market. So again, we're very diverse, but in terms of liquidity, some big names that you may know on QB would be Fannie Mae and Freddie Mac. They trade OTC QB on our market. On our top brand, if anyone here is involved with crypto or digital assets, the Grayscale Bitcoin Trust used to be on our OTCQX market. They're now on our NYSE ARCA as they converted to an ETF. But to answer your question, Shelly, we're a very diverse market. of companies, big and small, both foreign and domestic.
Thank you. Anna, you mentioned earlier some methods of how you effectively have a platform to raise capital and to help small companies and prepare to go uplisting wherever. Could you get more into the weeds on how the CSC helps in the capital raise situation?
Sure. I think one thing that might be counterintuitive to companies out there looking to raise capital that are startup and growth is to leave your country where you're operational and go to another country to go public, especially when you have such a robust capital markets here in the US. But I think the real opportunity, especially for startup and growth companies, is that we have an easier playground in Canada for you to start. You have a smaller distribution requirement, you have probably less reporting requirements than you would on, or you definitely have less reporting requirements than you do on the major exchanges in the US. What this offers for small and startup and growth companies is the opportunity to start out in the markets, raise some capital, get your OTC ticker, come down to the US, be able to market yourself here, do some capital raises here, and when you get to that size that you're ready for a larger exchange, then you're seasoned. You've had your reporting periods, you've gone through your management team, you've executed your business plan, and you've seen how the market has reacted to you. It's a really big exercise, and I think sometimes people forget that your company becomes two companies when you go public. You are your operational company, and then you're your capital markets company. And the capital market side, especially if you're raising capital in more than one country, you have a team of people, a lot of the people that are sitting here with me today, that you need with you in every jurisdiction that you're trying to raise capital. I think Shawn said something interesting talking about kind of the regular interaction with investors and making sure that people are aware of you. People forget and they kind of focus on this IPO exercise. But the point of being a public company and your disclosure requirements and the cost around that is that, especially if you're startup and growth, you're going to be going back to the market to raise more money. And if you're going to go back to the market and raise more money, you want people to know about you. You want to have liquidity, and you want to have a decent share price with potential upside. So I think using kind of the Canadian markets is a real opportunity and a unique opportunity. We certainly saw it in the cannabis space for US companies where you couldn't list here. That was a bit of a unique situation, but Canada is a really unique opportunity for US and global companies that want to get their feet wet in the capital markets.
Okay, Joe Alagna.
Yes.
You're sitting in your boardroom, and in walks an issuer. What advice are you going to give that issuer about doing an offering, going public? You got 35 years experience. You know what? I want to hear what you have to say.
If I was in real estate, I'd say location, location, location. But in the brokerage business, it's management. It's, you have to have a strong management, experienced management team to run a public company. Whether it's micro-cap or a large cap company, it doesn't make a difference. You need to have an experienced and independent board of directors. So this all needs to be really thought out before you make the decision and the plunge, before you can say, I want to bring my company public. But you also, your value proposition, you need to make sure that you're able to convey that to the street and articulate it in a proper way that, people understand your business model is scalable and sustainable. And you need to be dedicated to be doing that on an ongoing basis. I see too many companies come public, and they think the day that they come public and the day you close is like graduation. Well, that's the birth. That's not the graduation. It's all just starting at that point. So this is really a dedication to, all right, now I'm a public company. There's things that come along with it. There's a lot of costs that we've been talking about up here. Since Sarbanes-Oxley didn't help micro-cap companies in 2002, I'll tell you that much, on how much it increased the cost for us, in proportionally to large cap companies. So, if you're gonna decide to become a public company and you do have a business model that deserves to be public, it's the long game. The long game, you really need to think out the strategy and making sure that you're not a tree that falls in the forest. I think that kind of elaborate a little bit more on what Shawn was talking about. You got great research, but if you don't, if it's not, word's not getting out there, people aren't seeing it, people aren't hearing it. You can put up great numbers and Some companies, they'll listen to their auditors, or no, just don't worry, don't listen, that's all noise. Don't spend money on PR, don't spend money on IR. You have to. It's a comprehensive decision. If you're an issuer out there considering going public right now, you really need to think about this and the dedication to, once you're public, getting out on the road, making some time, non-deal road shows, making a commitment to come to conferences like this and really empower the public and shareholders, many retail. I see too many companies come public through firms that only go and place the transactions institutionally, and then they wonder why the stock just after it goes public doesn't trade. Retail component and the retail interest from investors in the microcap market is essential. It's essential, and I think a lot of firms have gone away from this. It's not easy managing. We do retail at Joseph Gunnar. Our retail is involved in many of our transactions when we bring our companies public. We take it to heart. There's a reason why we were not in the public markets in 22 and 23, because we just felt it wasn't an opportune time to really push that initiative. We did a lot of private transactions. If you look at many of the public transactions that came public in 22 and 23, 90% of them were down substantially, like 80 to 90% within 3 or 4 months, because you're going into bringing a company public into a bad tape. So timing is important also. If you're thinking about bringing a company public, you need to understand, what's the best timing for my company to come public? Is now the right time? Is now things are getting better, things are improving. But what type of product, what type of mix am I going to have? If it's going to be all institutional, my transaction, it's going to be institutional and a retail mix. I think that's really, really more important now than it's ever been to have the retail investor involved, because when your company comes public, liquidity is a major problem right now in the microcap world. And if the stock does pull back, you're going to want retail shareholders in there to buy that stock, because a lot of institutions will make their bet and they'll sit back and then they trade the stock, and then they won't be around, and there's no way your stock's going to really be extremely volatile. So you need to embrace the retail investor more than ever, and I think that's really an important deciding factor on when you're going public and how you distribute your offering.
Thank you, Joe. You know what? Let's open it up to some questions. I can see out there everybody's got an inquiring mind.
This is for Joe, Alagna, but also the panel. One of the first things we started off with was a statistic you gave that the number of companies listed under $1 went from, I think it was 12 to well over 500. Yeah. All of our indices, all of our markets have seen the deluge of SPACs and the impact that they've had and the overwhelming failure that most of them have had. Right. What percentage of that increase from 12 to over 500 do you attribute to SPACs versus just simply deterioration of the companies, to evolution of companies, to failures, et cetera?
Definitely a good percentage. I don't know the exact number, but the SPAC race over the last several years, all the way up to even the bulge bracket firms were underwriting SPAC transactions. We chose not to. Again, I guess I'm not saying there's anything really wrong with the product in itself, but I've been doing this for 35 years, and when I first started in the 80s, we had something called blank check companies that came public, and when I saw the product, it kind of really reminded me a lot about the very similar. Like I've seen this movie, I kind of know how it ends. For the right company, the SPAC might be a great vehicle, but what I saw was a race for everyone to put up SPACs because it was an easy investment. The investors that were investing in the initial SPAC were just parking money. They were never converting the dollars at the end. They were just looking to get an interest payment. So, so I see, when you see an abundance, when you see everyone running, the herd's running one way, I always say run away from the herd. And I think that probably pays dividends now, because the majority of those transactions really did not work out quite well. So I think there was a good portion
I can help with that response too. So of the 500 that Joe mentioned earlier, about maybe roughly 200 are SPACs, a little bit less than that.
I was going to say, I'd say half. I was going to guess and say half. But even the companies that were operating companies that did get saw their stock price get hit quite a bit into 22 and 23. Some of those companies came public in 21, and when I was reading a lot of those prospectuses back then in a very positive market, I was saying this company should not be coming public. But anything was going public back then because you were in a bubble, right? And the same bubble I was in 2000 when the dot-coms. It's like every so often you're going to see this happen, and you'll see companies that probably come public and really haven't really thought about the commitment that I was just discussing, the long-term commitment that's involved here, or didn't have the right business model to really be a public company, come public in that market. And then, as soon as the bear market comes, I have a saying in my firm, when the tide goes out, you see who's not wearing their underwear.
One more question, please.
Hi. Could you please tell me where you would draw the boundary between paid or promotional research and regular research? What would be considered promotional? For example, if I was writing a report about an issuer and did comparable valuations of peer companies, and then say, potentially if this company, the issuer trade at that multiple, this is what it could be worth, not saying it would be, but it could be worth. Would that be considered promotional?
So I think from our perspective, we look at it as an opinion, being historical analysis, being it's historically traded here with standard deviation of, or the peer group, right? So one of the problems you have is, what is your job in providing research? Is it to provide an investment opinion or educate investors, give them knowledge, help them understand the key drivers, the milestones? And I think historically the industry had some bad actors that would be really promotional research, right? That would go out and really try to pump stocks, talk about, avoid the fundamentals. Maybe there weren't any fundamentals for the company, which is why they were doing that as part of it. But the idea is to really create a package that educates an investor. That's why we don't do opinions or price targets in our methodology, because we view our primary job is to build awareness, then educate and engage the investor. In the end, you hope they make their own decision, and I think that's where the promotional side of it, hey, buy this stock, it's going to 1,000, that kind of a thing has done more damage. So there's a whole new field out there in white space to create better and more useful research for all investors. Be it, I can tell you from our readership, it ranges from portfolio manager at Royce and a Wellington all the way through to an RIA, right? I mean, everybody's accessing that. And I'll tell you the other thing, no matter where you are, research begins with a Google search or whatever your favorite search engine is. I don't care where you are. You're going to search, and what do you find? What's the digital footprint? Is it useful? Can you learn about the company? Because we all know that you only have a small time to interact with an investor to get them engaged, right? So what do they find? And I think this goes back to defining what is research, right? What is it today, and what does it mean? And I think it's a very different thing for a small and micro-cap company. What does true research support and education mean versus what Alphabet's going to need, or Tesla, right?
Thank you.
Just a little off-the-wall question. I've noticed over the last couple of years on the internet that the financial research has really gone downhill, and okay, maybe a little bit of a tinfoil hat thing, but maybe you're interested in seeing that. Do you think that people are poisoning, like a lot of the financial research now is AI generated, right? Like it's just, everyone's like, oh my God, it is. Do you think a lot of it's actually being poisoned? Because a couple of times I've been doing research, I look at that and it's like, that's just not right.
Right.
And then you kind of dig down a few layers in the Cedar and Hoover, and you're like, somebody's really, like the AI guy. So, I mean, just asking you, is it that bad, do you think?
Well, I think it begins with, when you're not writing the research with a thesis behind it, right? So that's just information tidbits that they put out. When you really think about a research product, it's helped to design the framework, the investment framework of that company, right? So it's not as simple as, putting a blurb out on something. It begins with, what is the investment thesis behind it? What are the milestones? Are they tracking towards the milestones? What do you as a public equity investor need to be aware of and watching, right? So it's not as simple as just a little piece of information in a vacuum. It has to be a real due diligence package that is ongoing. And I think that's where research and a lot of investors, especially retail investors, fall off on that. They read something on StockTwits and think that's, the end of it, right? And that's a piece that they can use and should use, when in reality there's an investment thesis that needs to be defined, and then you as an investor need to be focused on what that is, and the company needs to continually educate you and remind you of what those things are. The research has to kind of, what you did as a senior research analyst at a big brokerage firm, that's what they do with their clients. And so small investors have to look past that and really have a thesis and make sure the information that's coming out and the things the company are doing, and what as Joe mentioned, the management is doing to execute on that. Otherwise, your thesis goes out the window and you got to question everything you're doing and why you're owning the stock.
By the way, that was not an off-the-wall question.
No, that's that, and it's true, and it's something that's coming up a lot in our industry is AI-generated reports, which really don't go back to the root of what's the thesis behind it. What do I need to be looking for as an investor? It doesn't help you with that. It just throws these pieces out there that are just, clickbait.
So thank you all. From the bottom of my heart, it was a really informative panel, and I think our audience got something out of it, which is always our hope. And ladies and gentlemen, thank you for your attendance. Appreciate it.